Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a happy Sunday to you. We're here to give you the sincere and actionable ideas that you need so you can make sure you are thriving, not just surviving retirement. After all, it's tough out there. Everything works faster. Everything's a bit more complex. And if you need to start moving from okay to good or preferably good to great, you have found your home. 833-964-PLAN. That's 833-964-PLAN. Go out to getretiredstayretired.com. So, hey, I think there is an awful lot of stories that are floating in the media, but there's two stories, two in particular, that I think investors are going to be hearing an awful lot about the next couple of weeks. Number one, AI earnings season. Everybody knows artificial intelligence earnings season. It's officially underway. And second, yet again, that geopolitical hotspot. It's got oil markets reeling higher. Got to tell you, I enjoyed $67 a barrel. I didn't like 112, nor do I like things that start with a 9 in the 90s right now. That being said, David, bring us into these two topics, AI earnings season and the oil.
Yeah, I mean, they sound like completely different topics, but I think they have something in common, which is they're both about risk and risk to 401ks and IRAs and all these investment accounts. But let's start with AI earnings, because I think that's really what's going to dominate the financial headlines over the next couple of weeks. Google reported this week, and now we wait to hear from the other big hyperscaler companies, the rest of the big technology companies. And I think everybody's going to hear these technical terms thrown around. Frontier models, tokage usage, AI inference, GP utilization. But honestly, unless you're using AI software on a daily basis, none of that's what really matters to investors.
That's right. So I think you want to simplify this entire conversation and just focus on two things. How much money are these AI companies spending? Right? Capital expenditure. And number two, how much are they making? Because again, these are investments. That's really all there is to it.
So let's start with spending, or what Wall Street calls capital expenditure, CapEx for short. Think of CapEx as companies building factories. Except instead of building factories, today's big tech giants are really just building AI data centers packed with incredibly expensive chips and computing equipment.
And let's talk about how this played out. Investors have loved for the last 2 years, seeing these companies spend aggressively. And the thesis has been so simple. The company builds the biggest, baddest AI infrastructure today. Whoever's got the biggest, baddest AI infrastructure today is going to win tomorrow. Hence, it's been somewhat of an arms race.
Yeah, but I think lately we've seen some of that enthusiasm cool a bit. One thing everybody's trying to buy the exact same hardware. So there's a race because we can't make some of this stuff fast enough. And when everybody wants the same semiconductors, networking equipment, everyone wants the same chips, the prices go up. But there's also another problem. Every company sees its competitors spending billions of dollars and thinks, oh, geez, if we're not spending billions of dollars, we're going to fall behind. So when one company raises their spending, another company follows. And I think that's got investors on edge. I mean, a while ago, you couldn't spend enough. And now I think investors are hoping that there's a little bit more, responsibility with spending.
Well, David, that's right. I mean, listen, Wall Street's changing its thinking. If you can't tell the tenor, the market tells you exactly what it's thinking. No one wants to see the capital expenditure in AI slow down, because if someone did slow down the CapEx, that'd be like akin to waving a white flag of surrender, right? But we don't want to see spending to explode in an endless closed loop. That's no good. And that explains what happened to Google here this past week, right? That's why the report got such a mixed reaction. Was the revenue solid? Of course. Is the demand still there? Of course. But investors focused on that one thing, $205 billion of capital expenditure, and people just don't want to let it get out of control. So if you've got questions about investing in AI, you want to know how to make sure you're future-proofing your portfolio for the changes and the tenor shifts that are here, give us a call, 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. But remember, there's another side of this, the revenue. That's really the bigger story, right, David?
Yeah, and the construction's expensive, right? I mean, think about this like opening a new manufacturing plant. A lot of money required up front, but once the plant opens, production starts to increase and sales increase. That's a good investment. AI kind of works the same ways. Companies have spent hundreds of billions of dollars building out the infrastructure, but now investors want proof that those investments are actually going to generate meaningful revenue. And that's, I think, the key. And if you go back, Craig, a lot of people make these parallels between like right now and the dot-com bubble. I mean, clearly the internet took off. However, some of those companies really didn't make money right away and they kind of rolled over. So I can understand where that anxiety comes from for certain investors.
No, I get it. Listen, it's not necessarily about the proof is in the pudding. Show me the money, right? You know, it's not about this quarter. It's not about next quarter. The market just wants evidence that everything's going to continue moving in the right direction. So here's the buzzword as we were talking about this. When you hear all the gobbledygook, all the technology talk over the next couple of weeks, because we're knee deep in earnings season, just remember that the market can be broken down into two very simple questions. Are companies spending responsibly? And are those investments actually generating returns? And if the answer is yes, which I think it is, the AI story is going to stay healthy. The spending keeps accelerating, but if you find that the revenue's not following, then everyone's going to get a lot more skeptical really, really quick.
So let's go on to the other topic, which is geopolitical. But I think investors are getting nervous about oil prices. We've seen oil prices now run back up into the mid 90s as of the close of last week, because traders are now watching something a little bit different. I think everybody's now familiar with the Strait of Hormuz, but there's something else in the news. It's that Bab el-Mandeb Straits, right? It's the smaller straits, and the other part where oil could be slowing down. And so that's got prices moving higher, and it's got traders making some changes to the way that they're preparing for the second half of 2026. So, Craig, I know this isn't as important of the Strait of Hormuz, but the stock market is starting to think it's important. What's the deal? What should people know about with this other part of the world? I mean, it's not too far away, but it's essentially down the street.
No, listen, I mean, no one knows how to pronounce it. We'll eventually figure it out. Just like I still don't know if Qatar is Qatar or Qatar. But that being said, I mean, ever since this U.S. fight went ahead and re-escalated here, the Saudis are moving an incredible amount of its oil exports, right? And instead of running that oil through the Strait of Hormuz, guess where it's going? They're sending it through the Red Sea and these other ports that David's talking about. And there's a large risk here. You got the Houthis in Yemen. They're threatening that shipping area. So this is all starting to expand. That doesn't mean I'm pounding the table to sell, but it does mean this. We may end up having longer delivery times. You may end up seeing higher insurance costs. Everything's becoming more expensive yet again because the oil prices are rising. So is it a market game changer? No, it's not a market game changer, but we got to have some perspective here, right? A perspective as investors. And the reason I think you want to have perspective is we had said something earlier in the year when we all started getting worried in March and April, which was you had to have oil trading under $100 a barrel because we couldn't stay high for more than 100 days. Well, we got that sweet relief. It was very, very temporary, and now we're right back up. So I got news. That shot clock has started once more. And what can you be doing in your portfolio? Well, there's a reason people should be investing for concepts like real return. We're going to talk about that later in today's show. But David, in the real return models, I'm pretty sure we added commodities a couple weeks ago, didn't we?
Yeah, we did. I mean, to me, owning great companies of America is your best long-term inflation hedge. But in the near term, right, that's where that commodities exposure really helps. If we have these sharp moves higher, which we've seen now, I mean, it's crazy that we went from 60 to 100 back down to, say, 75, and now we're back to 95. That's the reason to have that exposure at the margins portfolios so that you can hedge out some of this risk because it's clearly changing on a daily basis.
Yeah, I think there's a reason why people want to have hard assets in their portfolio. I think there's a reason why people want to have infrastructure and energy in their portfolio. I think after the weakness, the sell-off you saw, the January highs, I think precious metals, these things have places in portfolios. And if you want to develop a more sophisticated, institutionally backed and tested implementation, it's all about IQ. Not just intelligent quotient, implementation quotient for your investments, then I encourage you to learn more. Connect with myself, connect with David, connect with an advisor. Go out to getretiredstayretired.com. That's getretiredstayretired.com. And when you're out there, take a look at some of our important publications that you can be downloading, such as our 2026 mid-year outlook, your source for Trump accounts, so you too can see the thought leadership and guides that we have available. You're listening to Craig and David Bolanos. This is In the Know Radio, VestGen Wealth Partners on AM 560, The Answer.
You want more In the Know Radio? You want more In the Know Radio? You can't handle more In the Know Radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
Hey, we got to talk about the return that actually matters. I mean, this sounds incredibly simple, but it might be one of the most overlooked concepts in investing. So many investors focus on market returns, account values, benchmarks. Yes, all of that's important, but sometimes we got to pause because investors might be asking the wrong question. David, bring us into this discussion.
Yeah, you nailed it on the head, right? I mean, when you think about what retirees spend, right, and you think about utility bills, vacations overseas, all of these things, we have to figure out, retirees don't spend returns. They spend real stuff, tangible stuff. So when we are building portfolios, I think we're undergoing a regime shift, right? We went from globalization to deglobalization with a lot of these tariffs. And I think it's important that people start thinking about how they build a little bit more ballast, not with safe investments, but they build ballast to maintain their purchasing power over time. It's about maintaining a lifestyle, funding the retirement, paying higher healthcare expenses, helping family members, supporting charities. And I think that's why this concept of real return is becoming more and more important and why we talk about it on the show all of the time.
Yeah, so let's stop asking, how much did I make? Let's rephrase the question. What will my money actually be able to buy in the future? Because as David said, you ultimately don't retire on percentages. You got to retire on purchasing power. And the real purpose of investing isn't simply accumulating a larger account balance. It's maintaining that lifestyle that David mentioned. And that's where that concept of real return becomes so incredibly important. So David, let's define that. What exactly is a real return?
Well, I think nominal return is maybe what you see on paper. If you make an investment into a stock and it earns X, a real return to me is what remains after accounting for inflation, rising cost of living, and rising income taxes. In other words, it's the growth of your actual purchasing power. Because If your investments grow by, say, 10%, but your expenses are growing at 5%, you're really not ahead 10% because of that cost of living going up. So to me, it's really the practical value of your wealth, right? And over decades time, this concept, I think, becomes more and more important.
Yeah, that's so big because when it's measured over decades, this ends up unveiling one of the biggest misconceptions in investing, right? I mean, everyone just looks at a statement, shows gains, and assumes they're getting wealthier. But wealth, again, isn't measured by dollars alone. Think about the permanent reset we've had. This whole discussion. Do we have an inflation problem or do we have an affordability problem? We don't have an inflation problem. The year-over-year change in inflation is going lower. It is. The year-over-year change in inflation is declining. What do we really have? We got an affordability problem because the massive spike in inflation that happened in late 21 and 22 that caused everything to go 25 to 30% higher, that's permanent. So we had this inflation sprint, but your money hasn't gone back to the starting line. I mean, think about housing, travel, healthcare, college tuition. All those things have risen dramatically over time. Oh, by the way, coincidentally, all of those are the things that the government's involved in. So if you're starting to suspect that your investments aren't keeping pace with real world costs that you're going to face later, then you know exactly what we're saying. I want you to learn about real return investing. So go out to our website, getretiredstayretired.com. That's getretiredstayretired.com and download our guide on real return investing. So David, why is this just not getting talked about more?
I think it's just harder to define this, right? I mean, it's easy to flip on the 10 o'clock news or to put in the financial press, hey, here's what the stock market did today. But you have to kind of quantify this for retirees. And for a lot of families, to me, this is very specific to what they spend money on. So, we talk often, Craig, about families having a phased spending plan. And a lot of families I work with, the first 10 years of retirement, they have some bucket list things they want to do. And everybody knows that the last several years, global travel's hit an all-time high. Well, if you're traveling to Europe and the dollar is not worth as much as it used to be, that's becoming more expensive. And if you bring the entire family, and we do that 5 years in a row, that could be a major distribution from a retirement portfolio. So every family is unique. And I think that's why they don't really quantify that in the financial press. But I think that's really interesting because if you think about it, if you're buying luxury goods, if you're buying a car that is made in a different country, those costs have increased a little bit faster, perhaps because of a weaker dollar in certain cases.
So let's talk portfolio construction, right? Portfolio construction. It often focuses just on that mix of stocks and bonds. This whole thing we're talking about, real return investing with VestGen Wealth Partners, again, begins with a different question. What are the future liabilities and spending needs of you, the retiree? What specific forces could threaten or influence those future goals that you have? Inflation, currency fluctuation, interest rates, changes in global economic conditions. We got to start talking about those and then begin to build the portfolio with those specific risks in mind. So let's not chase returns. Let's preserve and grow purchasing power. And David, that's going to lead us to various thematics, such as going global. And why do you want to go global and not just have ADRs, but own the local currency?
Well, we live in a global economy. And as I mentioned, right, people travel, they buy luxury goods, and those are influenced by global supply chains. I mean, we learned this during the pandemic, right? That unfortunately things have to travel halfway around the world to get here. And when we have global supply chains like oil, commodities, we're importing things, currency prices can affect the cost, and we need ways to hedge that out in portfolios. So I think investors sometimes don't realize that inflation is not just a US issue. It is a world issue.
Currency side, guys, you could have earnings in the United States at 9%. You may have earnings overseas that's only 7%. I get it. A 9% return looks better than 7%. But if the dollar declines 4% and you owned local investments in the local currency, you take your 7% return, you pick up 4% on the currency arbitrage. Now your total return's 11. Last time I checked, 11's bigger than 9. So you need to move beyond just normal asset allocation in a global footprint and make sure you work with a firm that can specialize and give you the advantage, which is a currency advantage, when you're talking about real return investing. And David, this isn't about a decline in the US dollar. The dollar remains and will stay the world's dominant reserve currency. That's not changing. But we've seen action by these other countries, these central banks, these sovereign wealth funds. So to not approach de-dollarization with a thoughtful intent would be to leave clients short, right? So again, this whole concept we're discussing is about real return. And if you want to learn more, you can and you should connect with us online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com, because our approach at VestGen Wealth Partners is different. Our philosophy starts with defining client outcomes. And this conversation that David and I are having today, this morning on a Sunday, is incredibly important when it comes to those client outcomes. David, beyond investing in local shares and having that global footprint, how else can we hedge? Whether it be the concept of commodities we talked about, precious metals, the HALO acronym you use for infrastructure. Walk us through some of those ingredient weightings and why it supports the concept of real return investing.
Yeah, I mean, what's old is new again. So I'll give one very basic example, which is we've spent the first segment of the show talking about the big hyperscaler technology companies. But in order for all that capital expenditure to work, they're going to need, for lack of a better term, all of these utility companies, which generally speaking, that's been an out of favor investment strategy. But if you think of the new utilities of the future, it's fiber optics, it's tower, it's how are we going to power all of these things? And a lot of this is based off long-term contracts. So if you're an investor who's looking for different ways to play that AI thematic, you already have enough semiconductor exposure, you want the back end, the picks and shovels of the AI, and you want some stabilization with prices, and you want an inflation hedge, then we have to go back and look at some of those traditional investments. Utilities is a very broad term, but we can refine that very specific to this new economy, this new regime that we're entering.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. Connect with us so you too can learn how VestGen Wealth Partners is approaching defined outcomes, solving not just for nominal returns, but solving for what matters most, not percentages, but your purchasing power, because that's what allows you not to survive in retirement, but to thrive. You're listening to Craig and David Bolanos. We call this In the Know Radio because it's on your favorite station, the station that's got all the answers. It's AM 560, The Answer. Stay tuned because you might be financially secure. You probably want to know why you don't feel like it. That's coming up next.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
You know what? I love Sunday mornings because we get to free flow in a longer format and get people the information that they want. If you listen to AM radio, you're like me. You're a news junkie. You value information. You want education. And you know what? You might be one of the millions of Americans who have done so many things right. You've saved, you've invested, you stayed out of debt, yet for some reason, you don't feel financially secure heading into retirement. Why would that be?
It's because retirement isn't just about money anymore. It's about confidence. I read an article in Kipling not too long ago that made a really good point. that some of the most financially anxious retirees aren't necessarily the people that failed to save. It's actually the people who succeeded. They did a fantastic job saving money. They lived within their means. They paid off their mortgage. They're in really, really good shape.
So, David, hold on a second. Hold the presses. People who have done so many things right, who are well capitalized, well saved, you can have a bunch of money saved for retirement, but you still worry every day about money?
Absolutely. I think you and I both have sat across the table from couples that have done a fantastic job saving money. They have $3, $4, $5 million, and they're still questioning whether or not they can afford to buy a new car, right? Or they apologize for perhaps underwriting the family vacation down to Florida. They hesitate to remodel the kitchen. And it's a tough spot to be, right? Their emotions are getting in the way and could cause an issue in retirement if they end up making a poor investment decision.
No, David, and I know that whole thing sounds backwards, but listen, David's right. This is incredibly common. Think about what every successful investor's been doing for the last 30, 40 years. We've been trained to save. We've been trained to delay gratification. We've been trained to live beneath our means. We've been trained to cram money into our retirement plans. All those habits is what have made us wealthy. But retirement is asking everyone to completely reverse the course. Now retirement is telling us it's okay to spend. And I got news, that's psychologically difficult. So, David, how is it that at VestGen Wealth Partners, we've developed systems, not concepts, but systems that are tested in the trenches that allow our clients to spend and live with confidence because we see them worrying less, which means they're living more?
Well, you only get one shot at retirement. So I don't think it's a matter of, do I have enough money? Because whether you have 1 million or 10 million, there is always going to be anxiety stepping away from that paycheck. But this is why every conversation and every engagement at VestGen starts with, what's the plan look like? What does the retirement cash flow plan look like? And we have to put that stuff on paper so that someone has a guide to look at to say, this is the reason that we're going to be okay. We have planned for this. And it might not cure 100% of the anxiety, but perhaps it cures 90% of the anxiety. And that's why I think there's a difference between just having a portfolio and someone saying you have plenty of money versus someone like VestGen that says, here's why you're going to be okay. Let me demonstrate this in a very straightforward manner that you can digest, that has zero bias. This is just what the numbers look like. So it's the plan. It's figuring out what all of that spending could look like. It's not just what it takes to run your household on a monthly basis. It's what's your healthcare going to look like and how is that going to grow over time? It's how much are you going to spend on your son or your daughter's wedding? It's how much is that new car really going to cost when you buy it? How often are you replacing that car? What about some of the potential home remodels that are going to come through? And we would like to plan for the worst and certainly hope for the best. But if we don't put that stuff on paper, when it does eventually come up and you do have to go pay for that wedding, hopefully we can ease some of the fear that's already baked into our cash flow modeling.
Yeah, David, that's right. So when you go and visit with myself, David, somebody at VestGen Wealth Partners, it's a totally different conversation. Most advisors spend all their time talking about returns. We spend all of our time talking first about purpose. Other advisors ask how much money you have. No, we ask what's your money supposed to accomplish? The travel, the grandkids, the legacy, the charities. Because money without purpose becomes something you protect forever. That's no good. We're here to give you the agency to spend. And David, one of those approaches that we end up using is something as simple as account segregation, compartmentalization. Whether we talk about buckets of money or separate dedicated accounts for wedding and travel and cash flow reserve, weave that into today's conversation so people have an idea of what this can look like.
Well, I think seeing is believing, right? And so if you have all of your dollars in one spot, it's hard to kind of compartmentalize how you start taking that apart. But let's use healthcare as an example. Lots of families have ambitious retirement goals to retire prior to 65. But we know one of the big challenges for a lot of people is if you don't have retiree healthcare, well, where are the dollars going to come from? The nice thing is, under current law, you can get healthcare. The question is whether or not that's affordable. And one of the things I've learned is sometimes it's easy as segregating out the money to say, look, we've planned for this. We have all of the premiums ready to go for your ACA compatible health insurance sitting right here. Fear not, the money is exactly where it needs to be. And then we can cross-reference that with the website to show, hey, we're right on with what this is going to cost. But that's how we do it, right? Is we have to make some of this stuff visible, because if we leave it in the abstract, that's where people start to lose confidence. And I always say, like, really, really good advisory firms are those that are thinking 2 steps ahead. Where do we need to be in, say, 5 years? And what are the small strategic steps that we're going to need to get there? If the answer is simply, hey, don't worry, there's plenty of money in your portfolio, to me, that's not a good answer anymore in this environment. At VestGen, we're showing you why everything's going to work out, because we have it segregated out very clearly in your cash flow plan.
And I think that's really important because, there's a lot of people who had a separate vacation fund, a separate real estate fund, property tax fund, separate items. There's no reason you can't replicate that if you want. I think the big hidden danger, David, for so many people is they have one big IRA that's 60% in stock, 40% in bonds. It's just one big account. And you know what? Maybe that can work, but it might not create enough visibility and it might not be optimal. David, what's one of the most significant reasons that people need to take control of that large 401k, that large 403b when they retire, especially when it comes to taking withdrawals?
Well, we have sequence of return risk, right? And so I think when markets are trending upwards, it's easy to have this one big bucket of money that's always growing. But once we start taking distributions from portfolios, it really does matter what you're withdrawing from. So if the market's going up and you're taking a monthly distribution, that's fine, right? You're perhaps selling assets that are appreciating in value. But if the market rolls over like it did in 2022, do you really want to be selling stocks when they're down 15, 20%? Probably not. So to your point, Craig, we need to take control and make sure that we have a clear path so that if we do have sideways markets or down markets, that we can wait, let the stock market appreciate, but we have enough to kind of cover us for maybe 1, 2, 3, 4 years early on in retirement so we don't get blown up at the start.
That's right. And most of those 401k plans, most programs, if you have one big IRA, every dollar you withdraw is coming out proportionately from the stock and the bonds. That means if markets are declining, you're taking money out of stocks in a declining market. That's no good. I call it no bueno. That's definitive sequence of return risk. Remember, buy high, sell higher. Buy low, sell higher. You'd never want to be selling into a declining market, into a falling knife, and that's why you can't simply have a blended account that you flow from. Learn how to improve, how to be different. Get retired, stayretired.com. More on this topic. Craig and David Bolanos in the know when we come back.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
So how do you get retired and stay retired? Well, go to our website, getretiredstayretired.com. That's getretiredstayretired.com. There are 3 cardinal rules. We call them the 3 pillars of retirement income. The 3 pillars of retirement income. And pillar number 1 is capital matters, capital matters, capital matters. Once you've retired, you have to accept that everything you have is all you are ever going to have. And you have to place a higher degree of safety in those early years of retirement. You just can't afford to get blown up. And David, some of the ways we ensure that people don't get blown up is by investing using different techniques, meaning not just having one blended account, but having different accounts that we can pull from. That could be the so-called bucket of money strategy, right, David? Or you can also talk about some of the cap and cushion strategies you're using for people mid 2026.
Yeah, well, let's start with the basics, which is we need clear line of sight where those first dollars are going to come from. So if we determine that the portfolio draw is going to say be $50,000 a year, the first question we've got to ask ourselves is how many years of safe capital do we want to put on the sidelines just in case? Now, we've been lucky, Craig, that a lot of market declines in the last 5 years have been somewhat short-lived. In other words, the market fell, but recovered in, say, 6 to 9 months. So investors didn't have to wait very long. But if we go back to other time periods, 2008, 2000s, you had market declines. You had to wait 3, 4, 5 years in certain cases to get back up to par. So we've got to hedge out that risk first, that sequence of return risk. And I think one of the easiest ways to do it is to create permanence and definition. So invest in things that have a defined outcome where maybe your upside is somewhat limited, but at least you know what that return is going to be because you own the investment to maturity. And once we get that sorted out, then we can talk about the fun stuff, which is generating income and then growing capital for the long term. So part one is let's figure out how much runway we're going to need to make sure that we don't run into a challenge those first 3 to 5 years of retirement.
And that's the answer. You got to have 3 to 5 years of safe money first going into retirement, because that's consistent with pillar number 1 of retirement income. Capital matters, capital matters, capital matters. Well, what's pillar number 2? Pillar number 2 is you need to be generating sufficient income from your portfolio to cover your monthly spend. David, why do pensioners love retirement?
Pensioners love retirement because it's automatic, it's systematic, and they just get a direct deposit into their account, regardless of whether the stock market's up or down. But I think the key, Craig, and maybe what you're alluding to is if you have a portfolio that's structured to generate income, I sometimes think of like dividend investments as collecting the rent. You know, you might have a rental property, and while the property price could fluctuate over time, what most landlords are concerned about is, does your rent check show up on time? So we know stock prices are going to go up and down, but if you get those quarterly dividends, they're consistent and they're growing, then we're making some progress. But I think one of the most important things, and where we spend a lot of time at VestGen, and this is where I think I'll have you comment because I don't want this point to get missed, is where we take it a step farther is actually figuring out what type of income works well for your personal tax return. Because someone could say, hey, Craig, like I'm making 3.5%, 4% on my CDs in the bank. But then when we look at their tax return and 37% of it's going to the government, well, it sounds good on paper, but your real return isn't actually that good.
Hence the rise of real return. So we're talking about the pillars of retirement income. We just got done discussing capital matters, and we gave you some strategies you can use to adhere to such. Now we're talking about generating sufficient income on a monthly basis to cover the spend. That can come from what David said, interest on bonds, dividends on stocks. Maybe it comes from a combination of annuity payments, right? But the bottom line is some people are going to feel most comfortable doing something called income flooring. Income flooring is take a look at all your core expenses, your retiree health care, your mortgage, if there is one, your property taxes, your utilities, your insurance costs, your auto costs, all those things, and engineer a defined income flooring outcome so that no matter what, I call it 6 ways from Sunday, that the combination of your Social Security money, pension money if you have it, private pension money if it's done with an annuity, or the dividends and interest that come in no matter what, as long as your income is sufficient to cover all your bills, then you too can start worrying less and sleeping more, because you know that all of your bills are covered, because the totality of your portfolio generates enough cash flow on a monthly basis so that if you've got $7,500 a month of expenses, but you've got more than $7,500 a month of income, you're on easy street. And if you want to learn how to do that, call us 833-964-PLAN. That's 833-964-PLAN. Or go out to our website, getretiredstayretired.com. Remember, never squander a crisis. There's a crisis right now. It's a re-inflation on oil, causing bond yields to spike. You know what that means? Lock them in while you can. Lock them in while you can, everybody. Now, what David was mentioning a moment ago, as you're listening to Craig and David Bolanos, this is In the Know Radio with VestGen Wealth Partners, is how we customize. See, should you be in taxable bonds or should you be in tax-free bonds? Should you be having ordinary dividends or should you be focused on qualified dividends? How can you move past the simple real estate investment trust mutual fund and move into true real estate or true infrastructure where you get the tax benefits of depreciation so that your rent and dividend checks aren't fully taxable to you? See, those are the things that we're doing at VestGen Wealth Partners because it's consistent with our philosophy, not of nominal returns. Remember, it's what we talked about earlier today. It's about investing for real returns. Real returns is not what you earn. It's what you keep after taxes and inflation, AKA protecting your family's purchasing power. But David, there's a third pillar of retirement income. After we've taken care of capital matters, after we've adhered and generated sufficient income to cover the spend, what's pillar number 3 in retirement? I think it's something about growing your capital base, right?
Yeah, no matter what, you still have to have money in the market because we still need to grow your capital base over time. And I think that's where sometimes the basic advice that's online misses the mark, because oftentimes the basic retirement literature says as you get older, perhaps you should be getting more and more conservative. And quite frankly, in real life at VestGen Wealth Partners, I think it's much different than that. A lot of our clients who are just moving into retirement oftentimes hunker down a little bit. They want to make sure that there's no big mistakes early on in retirement. But as they grow confidence, as one of my clients said the other day, as I get my sea legs going into retirement, then their confidence with their portfolio grows. They can be more assertive with the portfolio. So I think the takeaway is regardless of age, you still need to own some of these great companies of America and continue to ride the wave.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Download some of our complimentary guides so you can understand the thought leadership that we put into the marketplace and take advantage of a complimentary strategy session. Sit down with myself, David, one of our valued team members, so we too can help you get where you need to go most, which is thriving, not simply surviving throughout retirement. And our VestGen Vision Path planning process is going to help you get there. You're listening to Craig and David Bolanos in the Know Radio.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
So what is it that makes VestGen Wealth Partners different? Well, number one, it's that the advisors, I'd like to think we have the heart of a teacher, because ultimately education's empowering. The results one gets is directly related to how good and how robust the communication is. But you can't just have a heart of a teacher. You've got to have a multidisciplinary firm That means you've got to have specialists. You have to have certified financial planners. You have to have investment advice under a fiduciary standard. You have to have the taxes. You got to have the legal. And you got to have the retiree health care in addition to the long-term care planning. You have to have all those resources under one roof because it's a comprehensive, holistic look at what's important about money to your family, because we don't want things to have to be outsourced. We want it to be all in-house. And you don't have to utilize all the services, but how incredibly refreshing is it when your advisor speaks and sits directly across the desk from your CPA, when your advisor sits directly across the desk from your legal team, when your advisor can phone the friend and simply say, we need to re-examine the retiree health care for the family and talk about how to save money on premiums and how to coordinate the care. It's that coordination of care that we specialize in at VestGen Wealth Partners. And I want you to have a chance to experience it. So go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com, and take advantage of a complimentary consultation. Let's walk you through that collaborative planning first narrative that we follow, because truly, if you want to start moving from good to great, you want to start having the permanence and the definition. You want to start achieving the concept of real return investing. It's going to take more than just stocks and bonds. It's going to take more than just publicly traded securities. You're going to have to learn and experience the world that is private investments, things that also are more durable, because you need to future-proof. That's future-proof from taxation. That's future-proof from the changes that are already underfoot of AI. What can you be investing in, and why can you be investing in it in such a way that artificial intelligence isn't going to reprice it? And how is artificial intelligence not going to replace it? All of those items are core to our DNA. GetRetiredStayRetired.com. You've been listening to Craig and David Bolanos. This is In the Know Radio, VestGen Wealth Partners on AM 560, The Answer.